Welcome back to the Market Podcast. Asymmetric info for individual investors. Educational info only, not financial or legal advice. Consult a pro before investing. Imagine a company that just skyrockets from a tiny startup to this multi-billion-dollar revenue machine. I mean, powering the data behind huge names like Forbes and Toyota, it's a story of just explosive growth. Truly remarkable.
It really is.
But, lurking just beneath the surface, there's this critical question. Can this powerhouse keep sprinting without escalating expenses just dragging it down?
That's $1 million question, isn't it? Or maybe $1 billion in this case.
Right. So today we're dissecting MongoDB. It's a company where, ambitious expansion is constantly meeting the relentless climb of operating costs. For you, our listener, who sees companies soar and, sometimes stumble, we're going to try and uncover whether MongoDB can actually master the art of scaling smartly.
And it's not just about the numbers on a balance sheet.
No, exactly. This is a story of leadership, strategic pivots, technological breakthroughs. Our mission really is to explore if this company can truly balance its bold growth ambitions with the fiscal discipline needed to supercharge its path forward.
It's true. So many companies get laser focused on that top-line growth, right?
Right.
But MongoDB's journey, it offers this masterclass in the often overlooked challenge of managing the costs that just inherently come with that kind of rapid expansion.
It's a delicate tightrope walk.
It really is.
Yeah.
And their leadership team is right there at the heart of this balancing act, making decisions that ripple through, every part of the business.
Absolutely. So, let's start right at the top. Guiding MongoDB is Dev Ittycheria. He's been president and CEO since 2014.
Right, and his track record in enterprise software is, it's genuinely standout.
It really is. He's known for successfully scaling companies like BladeLogic, acquired for a massive $800 million, and Aperture, which was later sold to Dell.
Big exits.
Huge. He was the seasoned captain who navigated MongoDB through its 2017 IPO and crucially steered it firmly into the cloud era. It's really under his strategic vision that Atlas, their flagship cloud-managed service, transformed into the primary engine for their growth.
And his strategic decisions are particularly insightful. They reflect this forward-thinking approach that directly addresses the economic challenges of that rapid growth.
How so?
Well, consider his emphasis on prioritizing AI integrations in 2024. This isn't just chasing a trend, It's a deliberate positioning to capture the generative AI wave.
Okay.
By focusing on high-margin features that naturally attract premium customers, they're aiming to grow revenue efficiently. Making sure each new dollar of income isn't just matched by a proportional jump in expense. It's about optimizing the return on those significant R&D investments.
Smart. And he's certainly not navigating the ship alone, is he? The supporting cast at MongoDB is equally formidable.
Definitely.
You've got Cedric Petch, President Field Operations. His deep sales expertise, honed during leadership roles in EMEA at DocuSign, has been absolutely instrumental in fueling MongoDB's global expansion.
Right, directly contributing to Atlas revenues soaring to, 71% of total revenue in fiscal 25.
Exactly, 71%. Then there's the new CFO, Mike Berry. His role became effective in May 2025.
Ah, yes, recent appointment.
Berry brings significant financial management experience from Rapid7 and McAfee, and his focus on margin expansion, it's already visible. Fiscal 2025 saw 24% Atlas growth amid proactive cost controls. That signals a very strategic push for efficiency, hand in hand with scaling.
Mike Berry's appointment, especially now, it really underscores the company's clear commitment to financial prudence. It sends this deliberate signal to the market that, while growth is still paramount, managing the bottom line and ensuring sustainable profitability is just as critical.
Have a dual focus.
Exactly. It's crucial for navigating those cost pressures in a rapidly expanding tech company.
I see.
You also have Paul Kapombasis, the Chief Revenue Officer. He leverages his extensive Salesforce experience to refine MongoDB's go-to-market strategies.
Okay, what's he been doing?
He's been instrumental in implementing targeted enterprise deals. These are specifically designed to reduce customer acquisition costs over time, aiming to make their sales efforts not just effective, but, increasingly efficient in the long run.
Makes sense. Beyond the executive team, there's also robust board oversight, providing invaluable guidance. Co-founder Dwight Merriman offers critical continuity on the board. He provides strategic input, particularly on the technical roadmap.
Which is important, keeping that connection to the original vision.
Right.
And Tom Killalea, a former Amazon executive, serves as chairperson. He contributes invaluable advice, especially on crucial things like cloud scalability and fostering multi-cloud partnerships.
And those partnerships are vital for mitigating vendor lock-in risks. That, in turn, helps keep their operational costs flexible and competitive.
So this strategic alignment across the whole leadership team, sales, finance, the board, it's profoundly important.
Absolutely. Their combined expertise in software scaling and financial prudence is actively shaping the company's approach, trying to grow without those unchecked, spiraling expenses that can just plague fast-growing tech firms.
You see this in their R&D allocation.
Yeah, you do. It consistently sits around 25% of revenue, which is, well, notably disciplined compared to some industry peers who might spend a higher proportion just chasing new ideas without that clear path to profitability.
Okay.
Overall, this leadership team, they're sharp, experienced, deeply aligned on growth. But the ultimate test, it remains whether they can outpace intensifying competition while maintaining that crucial economic discipline. That's the core challenge.
Let's delve a bit into the company's origins and the founder involvement now. MongoDB was originally founded back in 2007, but under the name 10gen.
Right, 10gen. By Dwight Merriman, Elliot Horowitz, and Kevin Ryan.
And they drew heavily from their experience at DoubleClick, recognizing the growing limitations of traditional relational databases. This was when the internet was truly exploding, demanding more flexible data storage.
Dwight Merriman's continued strategic input as co-founder and director is quite significant. He still provides valuable guidance on the board, especially on technical roadmap decisions, like that pivotal shift to document-based models.
Gives them that link back to the founding vision.
Exactly, that continuity.
What's insightful here, though, is that while the founders undeniably laid the groundwork and shaped the initial direction, MongoDB isn't really founder-led day-to-day anymore.
No, not in operations. Elliot Horowitz, the former CTO, stepped down in 2021, and Kevin Ryan, the former CEO, transitioned out even earlier.
Instead, it's Dev Ittycheria, with his proven enterprise leadership, his history of steering companies to multi-billion-dollar exits, who really captains the ship now. His track record, well, it speaks volumes about scaling tech companies.
And this structure, it allows for a more traditional corporate governance model, which, can often lead to greater financial discipline, a more focused operational approach. A key element here is the strong alignment of incentives with investors.
How so?
Executive compensation is heavily tied to stock performance. For example, Ittycheria's package includes restricted stock units that vest based on concrete revenue milestones. It ensures leadership's financial success is directly linked to the company's performance, to creating long-term value for shareholders.
And this structure seems to be working, right? Based on their consistent over 20% annual revenue growth.
It certainly appears so.
But here's where the challenge truly emerges, that rising expense ratio. Especially with sales and marketing now accounting for 45% of revenue. That's going to be the ultimate test of whether this alignment can truly rein in costs without stifling the innovation that's absolutely necessary for continued growth.
Which leads us right into how a clear mission and vision can directly inform their approach to managing costs. MongoDB's mission is crystal clear. Empower innovators to create, transform, disrupt industries by unleashing the power of software and data.
Okay.
This mission directly drives their goal of becoming the default database for modern applications, particularly those driven by AI. You see this in features like vector search, designed specifically for generative AI. This focus on high-value, cutting-edge applications, it inherently supports more efficient revenue generation.
And their vision for the future.
Equally compelling, a unified, multi-cloud platform that simplifies global data management. This vision is manifesting through initiatives like the MongoDB AI Applications Program, or MAPP. They're partnering with leaders like Anthropic and AWS to efficiently handle demanding AI workloads.
And the company culture plays a role here, too.
Definitely. It's explicitly aligned. Core values like think big, go far, emphasize innovation, while embrace the power of differences, fosters diversity. They have programs like neurodiversity celebrations, security champions, embedding accountability.
Right.
This culture is crucial. It attracts top talent, over 5,000 employees worldwide, and aligns them towards goals like cost-effective scaling through agile development. It's foundational to their drive for efficiency.
So the central question remains, can this visionary culture effectively curb rising R&D and sales expenses, both up 20% year over year, to sustain growth without dilution?
Let's turn now to the journey of innovation, their history, their track record. MongoDB's story began in 2007 as 10gen, founded specifically to tackle the scalability issues of traditional relational databases struggling with the internet's explosion.
The pivotal moment was 2009, the launch of its open-source NoSQL database. This marked that crucial shift to flexible document models, capable of handling unstructured data at scale, a true game changer, just as the DoubleClick founders envisioned.
Right. By 2013, 10gen rebranded to MongoDB, solidifying its identity.
Then came the 2017 IPO, a significant milestone, raising $192 million at 24 times per share, fueling major expansion.
But the journey wasn't without its, let's say, defining battles. In 2018, they made that controversial decision to shift the license to the server-side public license, the SSPL.
Right, I remember that causing a stir.
It did. It wasn't just a legal tweak. It was a bold move to protect their IP and revenue from cloud giants who were leveraging MongoDB's open-source work without contributing back. Necessary for long-term sustainability, maybe, but it definitely ignited debate in the open-source community.
But then came the truly brilliant strategic move. The 2016 Atlas launch.
Ah, yes, Atlas.
This cloud-managed service was a significant pivot from just on-premise solutions to a database as a service or DBA model. It perfectly positioned them to capture that massive cloud migration wave.
And the numbers speak for themselves. By fiscal 2025, Atlas drove 71% of their $2.1 billion total revenue, up from $1.8 billion, with a robust 24% year-over-year growth. That's real foresight.
And their adaptation to disruption, it's been relentless, consistently delivering product updates like 2023's version 7.0 enhancing query performance and 2024's 8.0 with over 45 architectural improvements specifically for AI workloads.
These adaptations directly respond to market shifts, like the AI boom, keeping their tech at the forefront.
We can quantify their success by looking at the customer base, over 57,000 by mid-2025, up from 52,600, contributing to an estimated NoSQL market share of around 25%. However, they've faced challenges too, like slower adoption for self-hosted solutions, which highlights that ongoing balancing act. R&D expenses have necessarily increased to support these pivots, leading us to ask if they can keep innovating at this pace without cost overruns, eroding that impressive 20% plus growth.
Okay, let's explore how it all works, the business model. At its core, MongoDB's business is elegantly simple. Provide a flexible database platform for storing and querying data in modern apps.
Think of it like a digital filing cabinet.
Exactly, but one that adapts to messy, unstructured info social media posts, sensor data, unlike rigid SQL tables.
So it's the brain behind apps needing quick, scalable data access, like Netflix using it for recommendations.
Precisely. Technically, its document model, which is JSON-like, allows for remarkable schema flexibility.
Yeah.
Now, there are complexities like sharding, breaking up massive data sets, or aggregation pipelines for complex queries.
But the core idea is flexibility.
Right. Think Lego blocks, easy to rearrange, versus a fixed puzzle like SQL. This hybrid simplicity-complexity helps investors eyeing growth grasp the value prop. But the cost-side high sales expenses educating enterprises fuels that challenge of scaling without proportional cost hikes.
What's unique about MongoDB's model is how it intersects developer empowerment with an economic engine built on recurring subscriptions. Atlas, the cloud service, is now 71% of revenue, showcasing their NoSQL flexibility.
And unlike relational peers like Oracle, MongoDB thrives on unstructured data. Atlas offers multi-cloud deployment, AWS, Azure, Google tackling vendor lock-in concerns head-on.
There's that Forbes case study, right?
Yes, Forbes migrated for real-time analytics, achieved a 90% reduction in query times and significant cost savings, shows the real-world impact.
Plus the freemium approach. Community Edition hooks developers, leading to paid Atlas upgrades for scaling.
It's a smart funnel. The uniqueness lies in its developer-first design. However, rising operational expenses, like cloud hosting, are testing if this model can truly balance growth passion with cost discipline.
Their distribution model is also strategic. Direct sales to enterprises, plus a self-service model via the website, with Atlas enabling instant signups.
And innovative programs like MongoDB for startups, partnering with accelerators for free credits, plus integrations with AWS Marketplace for seamless billing.
How does this support scalability?
Well, the self-service model drove 30% of new customers in 2025, engaging developers early for potential upsells. A startup like Anyscale uses Atlas for AI, scaling from prototype to production smoothly.
Over 57,000 customers now. But again, those high sales team cost 45% of revenue raise the question, can this model expand reach without inflating expenses?
On the bright side, revenue predictability is incredibly high. about 95% recurring from subscriptions, Atlas consumption-based billing, and enterprise advanced contracts.
So Atlas Pay-as-you-go grew 24% in fiscal 25, making up 71% of the $2.1 billion total revenue. And long-term deals stabilize cash flow.
Exactly. This predictability enhances stability. A net retention rate around 120% powerfully demonstrates expansion within existing accounts.
Like a Fortune 500 firm starting at $100 Atlas spend and growing to $500K.
Precisely, as they add more workloads. However, there's variability. Usage-based billing ties revenue to economic cycles, which can exacerbate the cost challenge during downturns. Rising marketing expenses for acquiring sticky customers must yield predictable growth to maintain that balance.
Now, let's explore the tools, their products and services. The flagship is the document database. Strong product market fit. Over 57 million downloads, 57,000 plus customers, powering everything from e-commerce to AI.
And the core offerings meet diverse needs. Community Edition, free, open source entry point, enterprise advanced, on-premise with support. And Atlas, cloud-managed, multi-region. Atlas particularly fits developer ease, handling over 1.5 trillion queries daily. Astonishing scale.
Their innovation commitment is clear. Recent launches, 2024's MongoDB 8.0 with 45-plus performance boosts for AI, vector search in Atlas for semantic queries, impacting AI apps like integrating Cohere for art models.
Making databases AI-aware.
Exactly. Their future roadmap. Deeper AI integrations via MAP, partnering with companies like Anthropic. Support for edge computing, enhanced security, like aiming for FedRAMP High certification by 2026.
That FedRAMP High is key for the government market. Important to note, they don't offer unique financial products for institutions. They're a data platform.
They're backing this with big investments, over $400 million in R&D in fiscal 25 for areas like time series data, queryable encryption. The vision is a unified platform for all data types.
But again, this brings us back to the core question. Do the costs for these innovations, up 20%, justify the growth they aim to secure? It's the central economic inquiry.
Okay, let's pull back the curtain and look at operations.
Yep.
A truly global footprint. US HQ in New York City, likely least for flexibility, focuses on executive functions, sales, R&D.
International HQ in Dublin handles AMEA operation support, compliance, plus key locations like Palo Alto for engineering, London for sales, Sydney for APAC expansion, and offices in over 10 countries for local developer relations. A distributed model.
Operationally structured how?
Software development in NYC Palo Alto, customer support from Dublin, and cloud ops managed via partners like AWS, Azure, Google Cloud. This strategy of outsourcing non-core activities, especially data centers, significantly cuts capital expenditure.
A lean setup aiding scaling efficiency.
Definitely. But the caveat, rising general and administrative expenses, 15% of revenue due to global hires, raise questions about maintaining cost balance as they expand.
As a software company, low vertical integration rate, relying on cloud providers for infrastructure. Atlas runs on AWS, Azure, Google Cloud control over distribution, not hardware.
Correct. Positive impact. No owned data centers cuts costs significantly. Vulnerabilities. Reliance on partners for uptime.
Compared to, say, Oracle.
MongoDB's model lowers operational costs ops around 20% of revenue, but exposes them to provider pricing hikes. Their digital supply chain includes open source contributions, strategic partnerships like the Google Cloud Next Award, strengthening resilience. But critically, this ties expenses to partner ecosystems, part of the growth cost puzzle.
Now, building the fortress competitive advantages, the Moat, the database market. Huge, estimated $96 billion TAM, an oligopoly dominated by Oracle, AWS, Microsoft.
The NoSQL segment, where MongoDB plays, is more fragmented, more open.
And MongoDB holds a strong position there.
Yes, around 25% NoSQL market share. This helps protect profitability through differentiation. Not a monopoly, but its document model's advantage with unstructured data shields those impressive 75% gross margins. Still, risk of commoditization if costs rise unchecked. Fiscal discipline is key.
They benefit from economies of scale, too.
Hugely. Over 57,000 customers spreads fixed costs like R&D, reducing per unit expenses. Atlas cost per query is down 30% due to optimizations. Compared to smaller rivals like Couchbase, this scale enables lower pricing, fueling their 24% growth.
But the counterpoint.
High cost of scaling sales, 45% of revenue, somewhat counters this advantage. Raises questions about customer acquisition efficiency. They also have strong network effects. The massive developer community, over 57 million downloads, continuously enhances product value. More users mean richer ecosystems, more tools, integrations.
Like the 10,000 plus MongoDB questions on Stack Overflow?
Exactly. That community support aids adoption, contributes to the 120% net retention rate. User growth, up 10% year over year, amplifies these effects. But maintaining momentum requires expense-heavy community events, adding to costs.
How about counterpositioning?
Strategically positioned as developer-friendly, contrasting with legacy system rigidity. Their multi-cloud offering directly counters vendor lock-in strategies like AWS DynamoDB. And the customer response: 70% of Fortune 100 companies use MongoDB for its flexibility.
Which leads to high switching costs.
Very high. Migrating data from document models involves millions in time and effort, extensive application rewrites, plus emotional ties, developer familiarity creates strong lock-in, supporting that 95% recurring revenue.
The brand itself is an advantage, too.
Absolutely. A trusted name in NoSQL, enabling premium pricing. Atlas often has a markup over 50% above self-hosted. Pricing power stems from product quality, 99.99% uptime, and strong developer loyalty built on open-source roots.
Do they have unique cornered resources?
You could argue yes. Patents on their query language, access to top talent drawing from Google, etc. Strategic partnerships like MAP. Their culture helps attract talent more effectively than peers, reflected on Glassdoor.
Process power. Refined processes like Agile release cycles version 8.0 in 2024 lead to quality advantages competitors find hard to replicate.
And proprietary technology, definitely. Significantly better, maybe 10x more flexible for AI apps, especially vector search, compared to SQL add-ons. Ambitious roadmap for more advancements there.
Timing has been on their side, too.
Exceptionally. Rode the NoSQL rise in the 2010s, capitalized on the cloud boom post-2016, now perfectly positioned for the AI surge since 2023. A first mover in document databases for generative AI.
Speed of execution is also key.
Rapid Execution 8.0, launching shortly after 7.0, optimized partner processes discourages rivals, but execution costs contribute to the overall challenge. Plus, open source heritage fosters ecosystem lock-in, and that unique AI focus gives them an edge.
Okay, mapping the future, growth prospects, a clear strategy.
Very clear, multifaceted. Deeper penetration of existing markets via Atlas upsells that 120% retention shows it works. Developing new markets like AI vector search. Expanding geographically APAC growth at 30%.
Key drivers.
The consumption model expands workloads naturally. Partnerships accelerate adoption. Notable absence of major M&A suggests focus on organic growth, confidence in their core offerings.
Growth potential looks significant then. Opportunities in new markets like government via FedRAMP High, new products like edge computing, potential small AI firm acquisitions.
Right. Risks from competition persist, of course. But past successes, like Atlas growing from $0 to $1.5 billion revenue, parallel Snowflake's 30% growth as a potential reward.
The range of applications is broad too. Retail supply chains, AI workloads, manufacturing telemetry implies high scalability.
Absolutely. Which underpins their total addressable market, or TAM, global database market. $96 billion by 2025, projected to grow at a 20% compound annual growth rate CAGR to $150 billion by 2028. DBerry is growing faster at 40% CAGR.
And MongoDB is positioned to capture.
Maybe 10–15% of this market, especially through AI adoption, up from their current 2%.
So key growth drivers: Atlas adoption, AML workloads, vector search, enterprise expansion, global footprint, and that developer ecosystem momentum.
Now, navigating the storm: risk, resilience, anti-fragility. Their digital supply chain is diversified via multi-cloud deployment, AWS, Azure, Google, mitigates single provider risk. Strengths: no regional over-reliance. Strategies like private links enhance resilience.
Customer diversity is also vital. Over 57,000 customers across industries, 20% finance, 30% tech. Geography: 60% North America, 25% EMEA. Demographics: startups to enterprises.
Crucial for stability. No single customer is more than 5% of revenue.
How sustainable is the competitive moat?
Short term appears sustainable, supported by high switching costs. Longer term risks: erosion from AI commoditization, or new entrants like Google's Firestore if tech shifts accelerate rapidly.
Which brings us to anti-fragility. Does MongoDB exhibit this?
I'd argue yes. It seems to strengthen in chaos. COVID boosted cloud adoption, benefiting them. AI shocks prompted adaptations, making them more robust.
Like a muscle getting stronger under stress.
Exactly. External stressors like competition prompt innovations. For longevity, they're positioned for secular trends. AI data explosion, 29% CAGR to 2034 projected. Ongoing cloud shift.
So their products likely needed far into the future.
High probability, maybe 90%. Data ubiquity ensures relevance. They've weathered downturns too. Recurring revenue proved resilient in 2020. They benefit from broad, enduring trends.
Main risks to growth.
Potential NoSQL market saturation. Competitive pressures, especially from AWS.
Known risks versus unknown uncertainties.
Known risks. Expense growth outpacing revenue are a core concern, and macroeconomic slowdowns. Unknown uncertainties. Disruptive new database tech emerging, unexpected regulatory changes on data privacy.
Let's look at the wider economic landscape, macroeconomics, interest rates.
Rising rates 2022-24 increased borrowing costs generally, but MongoDB's low debt around $1.1 billion in convertibles and substantial $2.3 billion cash buffer minimized the impact. Potential rate cuts in 2025 could ease expansion financing,
Trade tension.
can affect the supply chain via cloud partners, example U.S.-China relations. But the multi-cloud strategy diversifies risk and aids market expansion.
Inflation.
Squeezes margins generally up, costs up 15% for many. But MongoDB's pricing power helps offset this, and demand remains resilient as data is essential.
Any company-specific macro factor.
AI hype cycles are a double-edged sword. Boom drives growth, bust could reduce spending. Currency fluctuations matter with 30% international revenue, but they use hedging strategies like forwards.
Okay, the numbers tell the story. Current financials. Fiscal 2025 ended Jan 25 strong run, revenue soared, but expenses climbed. The core challenge.
Revenue growth hit 20% year over year to $2.1 billion, driven by Atlas's 24% surge. Robust demand, like a rocket gaining altitude, but watch the fuel burn.
Profit margins.
GAAP net loss narrowed to make it $176 million, a 98% margin. Crucially, adjusted operating margin expanded to 15%, reflecting efficiency gains amidst AI investments, like tightening a budget while funding a moonshot.
The rule of 40%.
A solid 35%, 20% growth plus 15% margin. Strong indicator for growth stocks, shows product market fit as customers like Accenture add workloads.
Return on invested capital, ROI.
Stood at 12%, up from 8%. Demonstrates smart capital allocation R&D yielding ROI on features like vector search. Cash and debt position is robust. Current ratio, approx 4x, strong liquidity, $2.03 cash. Debt to equity manageable 1.2x convertibles. And free cash flow grew an impressive 50% to $200 million. Offers flexibility for reinvestment.
Industry-specific metrics.
Atlas consumption growth 24%. Customer additions highest in 6 years, over 5,000 in Q1 FY26. But sales efficiency dips slightly, customer acquisition cost payback around 24 months.
It's a narrative summary.
Like a startup maturing.
Yeah.
Explosive top line from AI tailwinds. But R&D and sales expenses, 70% of revenue combined, whisper caution. Needs careful scrutiny.
How does it compare to peers?
20% growth, 15% margin holds up well against Snowflake, 30% growth, -5% margin, or Datadog, 10% ROIC. But peers like Oracle, lower growth, higher margins, highlight where expense discipline could improve. Strengths, higher retention. Weaknesses, elevated price to sales ratio.
Trends over the last 3 years.
Revenue CAGR was 35%, margins improving, GAAP net loss margin from getting a 15% to netting at 8%, free cash flow turned positive. Implications, sustainable growth if costs stabilize, otherwise dilution risks and downturns.
Careful management is critical.
Now, what are people saying? Current events, investor chatter, recent events. Mike Berry's CFO appointment. May 25, signaling cost focus. Commitment to Fed ramp high, June 25, opening government markets. Q1 fiscal 26 earnings, June 25, beat expectations with 22% revenue growth, positive signal.
Upcoming.
Q2 fiscal 26 earnings, all 26-25, could reveal more AI traction. Potential new partnerships post Google Cloud next. External factors. AI regulations, trade tariffs could impact. Investors closely watching expense ratios, Atlas uptake for signals on that cost balance dynamic.
The narrative online among individual investors.
Mixed, but leaning positive after filtering spam. Maybe 60% bullish, 30% neutral, 10% bearish. Two main drivers. Optimism on AI potential versus concerns about high expenses and competition.
Dominant narrative.
Optimism on MongoDB's AI moat, but frustration with cost eroding margins. Example quote. Atlas growth great, but sales spend killing profits, echoes bearish valuation takes. Conversely, using MongoDB for AI projects, vector search game changer highlights innovation excitement.
Trends in discussion topics.
About 20% focus on the expense challenge, 40% praise the tech stack, MARN integrations, MongoDB Express.js, React, Node.js, 10% worry over stock dips, around $228 recently. Overall view, long-term upside of cost contained, but short-term volatility is a concern.
Let's turn to the price tag. Valuation, not just numbers, it's your compass as an investor. Is the $16 B market cap at $228 share a bargain or overvalued given the growth cost dynamic?
We start with intrinsic methods, discounted cash flow, DCF, project future cash flows, discounted present. For MongoDB, project 20% revenue CAGR to $5 by 2030, AI-driven, 20% margins, cost optimizations, 10% discount rate, tech risk. Yields intrinsic value around $300. suggest 30% upside.
Sensitivity analysis is key here.
Absolutely. If expenses rise 25% year-wide, value could drop to $180, significant risk. If AI boosts growth to 25%, could hit $400, huge potential. Relative valuation. Price-to-sales ratio 8x versus peers like Datadog at 6x implies premium for growth. If EBITDA 50x forward high, but arguably justified by 120% retention.
Other methods.
Sum of parts. Value Atlas at 12B, 70% revenue, self-hosted, $4. Advanced methods like Monte Carlo simulations, factoring volatility, AI adoption uncertainty, show 60% probability of reaching $250 plus in 12 months.
As of August 5, 2025, stocks around $228 per share, margin of safety.
Buying below intrinsic value to buffer errors, like building a bridge for twice its load. At 228 users, $300 DCF estimate, there's roughly a 25% cushion. Protects against cost overruns, slowdowns, helps avoid overpaying.
Why does valuation matter so much?
Guides investment decisions.
Sure.
Overvalued stocks, risk corrections. MongoDB dipped 20% post-2024 highs. Undervalued offer potential alpha. Managers use it for M&A. Investors for timing. Essential and volatile tech where growth can mask underlying expenses.
Valuation method is best.
We favor a hybrid. Intrinsic DCF suits growth firms like MongoDB, captures AI upside, relative multiples, benchmarks against peers. Combine a robust DCF base adjusted by multiple comparisons for a comprehensive picture.
Okay, the investment thesis. Let's steel man both sides, bear versus bull. Bear case.
Arguments from institutions, Morningstar, no moat, $2.03 cash but high burn, and individuals, expenses killing margins, competition from Firestore. Argues overvaluation, all in for 50 McFCF, multiple ignores erosion from AWS rivals, high sales costs, 45% revenue, macro pressures, inflation squeezing margins. If growth slows to 15%, stock could drop 50%.
And the bull thesis.
Supported by institutions, Forbes migrations, and individuals, AI vector search game changer. Highlights capturing the 96-bit CAGR, 24% Atlas growth, sticky competitive advantage. Argues AI boom, 29% CAGR justifies premiums, cost controls, new CFO, could unlock 30% upside. Based on recent Q1 earnings beats, bull thesis seems more probable. AI tailwinds likely outweigh cost concerns.
Discount assessment.
At $228, trades at a slight discount, maybe 20%, to the bull case intrinsic value, $280, $300. Based on the probable bull thesis, AI growth trumps expenses, suggests a potential entry point for patient long-term investors.
So the big question, can MongoDB balance growth with costs? Our informed opinion.
Yes, it absolutely can. But it demands vigilant, consistent execution. We assign a 75% probability of success, rooted in its adaptive history and strategic AI leverage.
That history matters. Since inception, they've navigated scaling pitfalls. That 2016 Atlas pivot transformed revenue streams, now 71% of the $2.01B total.
We acknowledge the expense surge, sales marketing 45%, R&D 25% pursuing AI aggressively, analogous to past overinvestments that briefly hit margins but fueled long-term growth. But leadership's focus, new CFO push for 15% margin expansion, and operational efficiencies, V8.0's 30% cost per query drop, provide the tools. The 1 or 2% net retention proves investments yield sticky growth without proportional cost spikes.
From first principles, key truths emerge.
MongoDB's document model is uniquely positioned for unstructured AI data, where relational databases falter. Data shows 10x faster queries for vector embeddings, untapped by 80% of legacy systems. Many investors overlook this distinction.
While competitors like Oracle stick to SQL rigidity.
MongoDB's flexibility lets it capture a significant edge in that 96 billion B TAM, growing at 20% CAGR. Another core truth. Consumption-based billing aligns incentives, transforms variable expenses into scalable revenue, adapts well to downturns, like in 2020. Advice for you. Monitor Atlas metrics quarterly. If 25% growth persists, op costs become leverage, signaling efficiency at scale.
So why are expenses rising? Intense talent acquisition, 5,000 plus employees, aggressive marketing in a competitive NoSQL space where rivals like AWS DynamoDB undercut on price.
But counter-evidence supports optimism. Fiscal 25's 50% free cash flow growth to $200 shows discipline, paralleling Salesforce post-IPO. Success hinges significantly on AI adoption. If generative AI workloads double, as partnerships suggest, margins could hit 20%, balancing the financial equation.
Any insights retail investors might undervalue?
The open source heritage creates a powerful flywheel, 57M plus downloads, often missed in valuation multiples, potential 2-3x returns if costs stabilize. Also, pursuing FedRAMP high certification opens a $10 Bay government TAM, an edge many competitors lack.
Strategic approach for investors.
Consider buying on dips, maybe below $200. Focus on long-term retention metrics, not short-term noise.
In sum, MongoDB is scaling smartly, leveraging AI for high-margin growth. Strategic moves are poised to outpace expenses through efficiency gains. This isn't just hype, it's a data-driven edge in a fundamental database revolution. As you consider MongoDB's journey, here's a final thought. How many other foundational technologies powering our digital world might be on the cusp of similar transformative growth, waiting to be unlocked by evolving markets and disciplined innovation? What might that mean for the next wave of technological progress and your own understanding of the digital economy?
Love this? Drop a like, subscribe, and ring the bell so you never miss a podcast.